For Wall Street Media, this is Emmy. I'm here with Doug, and we'll help you to make money in the stock market with information you can't find anywhere else.
Hey, and we've got exclusive stuff, and we appreciate you swinging into town, helping us out. We've got a video for Wachovia Strategist about inflation today. Who do you have for us?
I got Rich Gordon, fixed income market strategist with Wachovia Securities.
Okay, Jeremy, Mike, let's see Rich's video.
Hi, and welcome again to Market Summary Online. Last week, the equity market sold off sharply, fixed income credit spread markets widened, and oil traded above $125. The Fed continues to have their work cut out for them as they attempt to balance a credit and liquidity crisis and inflationary pressures simultaneously. Inflation is an obvious problem, and it probably means no further rate cuts. The average price of gasoline is already close to $4 a gallon and probably heading higher as we move into peak driving season. With food prices also rising and consumers feeling the pinch on all sides, further price increases would probably diminish consumers' disposable income to the point where a double-dip economic downturn becomes a very real possibility. It's easy to see how inflationary pressures have accelerated since the beginning of the year. One obvious reason is that most commodities are priced in dollars, and the dollar index is down another 5% this year on top of 8% last year. The dollar weakness over the past 9 months has been fueled by the monetary and fiscal stimulus used to alleviate a liquidity crisis that claimed one major investment bank and threatened to mushroom into a systemic failure of the financial system. But it's also important that intermediate and longer-term structural shifts have created an upward bias to inflation. The table shows a quick overview of the major categories and weightings that make up the CPI. The largest component by far is housing. In the CPI, housing more closely tracks the cost of rent than it does the cost of homes. So the 13% nationwide decline in home prices hasn't translated into a commensurate decline in this part of the CPI. Instead, the constriction in credit availability for mortgages has made it much harder to buy a home. People that haven't been able to get a loan or have defaulted on their current mortgages have become part of a larger pool of renters. This shift in demand from buying to renting has helped to stabilize the rental markets and in many cases allowed landlords to raise rents. Energy price increases have affected inflation in several different subsectors. The most obvious one is transportation, but several others have also borne the brunt of higher energy costs. Higher energy costs affect the housing calculation because electricity and other utilities are also included in that subsector. But by far the most surprising effect of skyrocketing energy prices has been to drive up the price of food. This is an unintended consequence of the push to use ethanol and other biofuel substitutes, although I think the potential impact of those policies should have been pretty obvious. The chart shows on a normalized scale the price increases of oil, gasoline, wheat, corn, and gold. Here are some key points. The prices of both corn and wheat are up over 60% in the past 12 months. The surge in wheat prices was particularly alarming. At one point, it was up 250%. Also, this chart doesn't include rice. The price of that commodity has increased so much that the United Nations and other human rights organizations have become very concerned that the increases might create widespread hardship in some regions. The price increase in gasoline has sharply lagged the increase in oil. This is reflected in the crack spread, which roughly shows the operating margin of oil refiners. It tightened dramatically during the second half of 2007, but it's been steadily increasing so far in 2008 and still has room to run. A return to a wider crack spread, which we've seen periodically over the last 3 years, can only mean higher pump prices for U.S. consumers. And they're already reeling from the prices they're seeing now. Finally, gold has lagged all these commodities, which is a little surprising given the store of value reputation that gold enjoys as a traditional inflation hedge. It probably is the case that some of the hot money that had driven prices up towards $1,000 has shifted over to other commodities as well as to undervalued parts of the world's stock markets after their sell-off. Considering the massive central bank intervention in the U.S. needed to stabilize the financial markets and the sheer amount of liquidity and capital worldwide that will eventually be necessary to patch all the holes left by the subprime mess, gold prices seem poised for another multi-year move higher.
Super cool, man. I love Rich Gordon. Everybody on Wall Street listens to him, and he's such a smart guy, and he's got such good character. I love him. And thanks for coming in and helping out today.
Oh, you're welcome. And we're here every day at Wall Street Media. You can find us directly at WSMCO.com. Thank you very much.